Hi, everybody. How's everyone doing today? Hi, Brock. Which top, Brock? Bitcoin or the S&Ps? Called them both. Hello, Alexandra. Kevin. Everyone doing okay? I also gave you guys some good ideas for Turnaround Tuesday yesterday. Narati, Hugo, how are you? Sinatra, Ren, TJ. Both? Okay. Hi, Didier. All right, let's take a look at what's happening today. So, okay. So yesterday there were quite a few Turnaround Tuesday fades. I don't know which one you chose, but I talked about Aussie having a 3 drive. You know what's interesting about Aussie right here, and this wasn't really the best, but you see this formation and this divergence and how we're holding here. So what I think is going on here is a fractal of what Blake has been talking about for the past couple of weeks. At the end of the rally, we have a little on a smaller time frame, head and shoulders possibly developing. And that happens with 3 drives too. So you look at the daily and you have the big head and shoulders, right? And you look shorter term and you have another head and shoulders possibly developing. Isn't that cool? Huh? When you get fractals of a bigger picture in the same chart, just different TFs. What do you think of that? Nice ride in the stock indexes arena. I know you were looking for a correction. Congratulations on that. Okay, so that was one of the turnaround Tuesdays. Aussie looks like it's getting ready to roll over. Even Euro, we had a nice reversal yesterday, right? I said that was another one. Um, I also said the one that I think really was a higher paying one was crude. Okay, we're trading up here. And you guys know I've been looking for shorts in crude once we cleaned out the 62 bears right here. Once we took out all the stops, the 62 bears up here, I said I'm looking for a lower high failing rally here in crude, and that definitely happened and could be underway here if we have a quality. You're looking, around $54 if we have a quality of this break here. Anyone do well on any of those turnaround Tuesday calls? Anyone take the short crude, short Aussie? Or how about this? I was pounding the table on it the last couple days. I got some comments like that I was crazy to be bullish. USD CAD looks like a bull flag following here. Oh, you did, Hugo? Good. You're a subscriber, right, Hugo? So Canada really came out of here with a vengeance. Yeah. Uh, oh, nice.
Yeah,
Okay,
we can't forget
nice.
the Bank of Canada today. We have their rate decision this morning. So,
Oh, I could forget it. I have a nice lead.
I
You
mean,
may not want to forget it,
it
huh?
definitely is set up ahead of the Bank of Canada.
Okay,
So,
when did they release their lies?
uh, it's
Huh?
it's it's in 2 hours.
Okay.
But I mean, that's their yeah, that's their statement. So,
Yeah.
um,
Okay. All right.
but
So
the fact of the matter is we had a really big rally from support yesterday. And between crude oil coming off, it's it broke below 63 yesterday, and now we're back below 62 this morning. We're actually nearing yesterday's lows, and you get crude selling off. You've got the Bank of Canada. With the Bank of Canada, you got we've had great economic Canadian data, but then again, the virus numbers don't look great there either. So, you have to ask yourself if they're going to follow the lead from the FOMC and, be a little bit more dovish. Where I think a lot of people are expecting more hawkish, but a more dovish Bank of Canada, this dollar Canadian can break through those highs. So anyway, I'm going to let you finish up, but
No,
but
I'm go ahead.
EOC is today.
I'm done now. I'm done
Oh
now.
no.
No,
Well,
really,
hey,
I
you
am.
get your well. Let me just mention this, Coach. First of all, you talked about turnaround Tuesday yesterday. We did get a bit of a reversal, and we've seen some pretty key turns yesterday. And I want to kind of be a little bit cautious now with long risk trades. Uh,
Yeah.
but at this point, we are starting to see the markets show that they're a little tired up at these levels. But before I even get into the markets and kind of my views here, I want to say what a great interview that you're going to have today.
Oh yeah, I noticed that Stell. I didn't even know Danny was on the MPC.
Oh yeah,
But
yeah.
yeah, and I've interviewed Danny before. He chose a very, kind of odd subject that he did a paper on despair. So he's going to be talking about despair in the midst of the most euphoric markets I've ever experienced. So should be good contrast to what's happening in financial markets. So that's his topic. So I know
Awesome.
every one of us has felt it, you know, maybe in our trading, uh, probably in our trading, sometimes in life, but I'm curious to what the economic effects are. And maybe it's going to be about, how they say this is a K recovery,
Yeah.
where the people that own financial assets, real estate, they've never been richer, and the people on the bottom part of the K, um, despair, haven't been able to pay rent for a year, et cetera, et cetera.
You
So,
know, that's a really interesting that's an interesting topic and a thought process. And I was actually, and this doesn't have anything to do with the markets that we're dealing with right at the moment, which we'll get to here in just a minute. But I want to say this in regards to what, and to your point, really in regards to what you're talking about. I was reading this article about real estate, because we live where I live, guys. Just so you know, I live in one of the hotter, if not one of the hottest real estate markets in the United States, and that's Phoenix, Arizona. Although when you're in here over the next couple of months, you would be thinking, why in the hell would anybody live where you live when it's 115 degrees here shortly here in the next couple of months? But 8 9 months, 8 months out of the year,
six.
no, it's really 8. I mean, it's like even
Okay.
right now when it's 90 some degrees during the day, it's still really nice at night.
Yeah.
And
Yeah.
during the day, it's not that hot. And anyway, I just want to say it's one of the hottest real estate markets in the country, here in the United States. But I was reading this really interesting article, and the reason why this is so important is because I was reading this article about how pension funds are actually coming in and buying real estate.
Homes. Yeah.
And this is not just here in where I live, but it's all across the United States. So uh, it's pricing out a lot of the first time buyers and people that just can't afford owning homes. So this is another, when you talk about the K recovery,
Yeah.
K style recovery, this is where it continues to segregate those who the haves and the have nots even further. Where yes, we've had financial markets, the equity markets. You've got 95% of U.S. equities are owned by the top 1% in the United States. Well, that so this is a pure rich get richer type of
Yeah.
situation with
Well, you
yes,
had to read A Tale of Two Cities in school, right? About the
yeah, yeah,
French
yeah.
Revolution, the best of times and the worst of times. It sure feels like it, doesn't it?
It does, but in the point I was trying to make here is, when you have these, this is not just my real estate market where I live, because I was actually reading about, I think it was in Pennsylvania, or no, I'm sorry, it was in like Washington, DC, but uh, there's 30 offers on a home, and the home was it's supposed to go for $250,000.
Yeah.
That was like the asking price, and it
s-
had 30 offers and went for 100 and whatever over
Yeah.
ask, and that's and a lot of that is institutional buying, bidders coming in, cash
Yeah.
offers. I mean,
Yeah.
you end up getting priced out of this market, and how what despair do you have, or how much despair do you have when you're just like you're beaten down, and when you watch like the home of your dreams that you thought you could buy, you just can't afford. And the people that own homes right now, it's great, but how about if you don't? I mean, now you're priced out of the market, you can't afford it. And so it's going to be interesting. I
Yeah.
think those are all
You get
topics that,
squeezed by landlords every year raising your
yeah,
rents.
I mean,
Yeah.
and yes, and the rents are just out of control. Anyway, we could go on and on and on about this,
Yeah.
but
You're making me feel despair.
yeah, I mean, but this is where this is where you start to run the risk of social. I mean, we're already seeing the what's the proper term I'm looking for here at 5 o'clock in the morning. I got a phone call this morning, and he's like, "Oh, Blake, I'm so sorry. I forgot it's like 5 a.m." I'm like, "No, it's 4:03 a.m." He's like, "Oh my gosh, you didn't have to pick up the phone." And I'm like, "Well, I'm awake now." I mean, I was in front of my computer, and so I'm trying to get my head straight at this time in the morning. But it just, the fabric of our society, it starts to kind of come unraveled. I mean, we've seen evidence of this in riots and and
We're
whatnot.
verdict away from all the cities burning yesterday.
That's true. I mean, that was we were, and I'm just going to say that it will probably continue. I don't see it
Yeah.
like stopping, and it'll be an interesting topic of conversation with Danny Blanchflower Flower today. If that's the road you guys end up going down.
Yeah.
But let's
He's a
talk a
big
little bit about
fisherman
FX.
too.
I'm
He's a
sorry.
big he's a big fisherman. He
That's
loves
awesome.
fishing. I mean, on his website, he has pictures of him holding up all kinds of fish.
That
Check it
is
out, Stellium.
great. I'm so opposite of the fisherman.
Yeah,
I'm not saying that
I
I
don't
would
have the patience for
fish.
it. I'd want to like spearfish.
That sounds. I could just see Coach
Anyway,
30 leagues under the sea
yeah,
spearfish with
yeah,
a scuba tank. Anyway, all right. So let's talk about currencies, and I'm gonna give you just kind of a little heads up really quick. So I was looking, for the euro to reach up towards the 618 retracement, but now what we're doing is we're coming back down towards the 119.90 level. Now remember, this is for those of you that are joining me and the guys on the Morning Edge after this webinar. You've seen this support resistance zone that we've been dealing with for the last couple of weeks. And, we knew this was going to be resistance and support up here. It's been a big, zone, if you will. And I think, if we get back below 119.90, you got to be a little careful with dollar shorts, because I think the dollar is at risk of having further gains. When you're in a risk off type of environment, the dollar should strengthen, but it'll strengthen more against certain currencies, especially like these commodity. And we watch crude oil's at lows.
yeah,
Crude's breaking yesterday's lows. Stocks are starting to turn lower here. Watch, the dollar Canadian could actually reach up towards this resistance even ahead of the Bank of Canada today. Anyway, I just want to say that the dollar index is at risk of a recovery, especially, this is our chart of the day yesterday. We had a hammer on, the daily candle right at the 618 retracement. So it seems like to me that we're going to recover back towards the 200-day moving average. And we could go further. I wouldn't limit it just to the 200-day moving average. That would probably be more the easy money if you're long the dollar. Back to the 200-day moving average. It's what happens after there, and whether or not we go further than that probably has more to do with what happens in equities more than anything. Now, speaking of which, if you take a look at the equity markets, we pulled back, and as we talked about yesterday, and I can't. It's hard for me to remember if we talked about it here or we talked about it during the Forex Analytics, client webinars, which would be, the daily roundup or the morning edge. But we were talking about how we broke through this channel support.
We did here
And
yesterday too, Blake.
we did. Okay.
Yeah.
Yeah. Cause you're not on with me on the other one. So that's why, it's like, for me, it's like, I talked about it yesterday. I'm just trying to register which, webinar I talked about it on. The importance of the 4110 level shouldn't go unnoticed. I know we wrote this down yesterday in our bias chart at 4110, and you notice I put an asterisk there. Now, again, these numbers that you see here are all numbers that we put together on the Morning Edge webinar, the Morning Edge webinar after this webinar for Forex Analytics clients. When we talked about the importance of 4110, that's before we got there, obviously. Now that you can see how many buyers came swooping in. The reason why this is so important is because if we get below this 4110 level, what that does is it actually forges out lower lows. And once you have lower highs and lower lows, then we're starting to see a shift in the trend. Is it complete reversal of trend? No, not yet. But what we're seeing is we're starting to see a shift lower. So, I obviously won't be really concerned with any longer term trend changing unless you break back below like this 3850 down here, because then you start creating, let me just grab I'll just use this really quick and I'll erase these. Actually, you know what? I'm going to do it this way. This is much easier because I can erase it all at once here. Okay. So I really won't worry about like the equity market, uptrend unless you start seeing these, get taken out, because as you can see here, we're clearly making higher highs, higher lows, right? So you have to get below, let me grab my eraser really quick. So let me get rid of that. Just bear with me. So you really have to get below this level here, this 3850, to where you really disrupt the uptrend. But what we're seeing now, and let me clear all these drawings really quick, and let me go back to a 4-hour chart. So now you go more intraday on the S&P. And obviously I'm not talking about the NASDAQ or anything else. I'm just really referencing more of the S&P here. But you see and let me change color. Okay. So we have a series of lower highs, a series of lower lows. And once we start breaking below some of these lows, that's when I start thinking, okay, well, now we're at risk of, stair stepping our way lower towards the, really critical support. And that's why, if you think about like where we're at seasonality wise, we are obviously, nearing May, and the old adage in equity markets, the sell in May, go away, is you sell, ahead of summer vacation, you go on holiday all summer, you come back into the fall, September, October, you look to reestablish long positions going into the Christmas rally. Just kind of map it out for the rest.
It's so easy.
It's so easy. Yeah. But sell in May this year may be a little bit more accentuated and may be a little bit more front run because we've had such an accelerated move over the course of the last year. So because we've seen such a 90% rise from the lows since, the end, or, COVID lockdown in March of last year, you might get that selling coming in a little earlier this year, which, that this might be the start of it, the last couple of days. Remember, we're only a week and a half away from the beginning of May. So you might see some front running here. And that's why, as we go into the summer, I would assume, and remember, nothing goes up and down forever, or straight down or straight up forever. We're going to start seeing some, sideways price action probably over the next couple of months. which is fine. What I'd be more concerned with is we don't take out this 3850 level too quickly, or maybe even over the summer, because what would scare the daylights out of me is, let's say we had a really big and aggressive sell-off here this next month and we break through 3850 and we trade down towards 3800 or 3700, then I would be more concerned with the overall picture of equities going into the fall. You know what I mean? A lot of people say, well, hey, Blake, and they ask me these questions all the time. Hey, Blake, the euro got to, the 120 level. You said, a couple of weeks ago, you'd be a buyer here if we got back to 120. So we're back at 120. It's hard for me to answer that question or to make, like assumptions ahead of time, because you want to know how an instrument got to where it's at, how quickly, what was the price action, how quickly, how long, how aggressively. And that will tell me as a trader a lot of how I want to react to a currency or an instrument once it's there. It's not, oh, it reached this price, I'm definitely buying or I'm definitely selling. No, I want to know how quickly it got there. If the S&P broke, like, let's say over the next 2 days, we absolutely just took a 10% haircut and dropped from 4,100 to, 3,600, like in the next 2 days, I would be very hesitant about trying to buy down there, because, when you sell off that quickly in a short period of time, that would scare the crap out of me. Right, Dale?
Yeah. Well,
yeah. So, anyway,
yeah,
that's why I think over the course of the next, few weeks, it's going to be, I expect us to bounce around and, probably have a, 5 to 8% correction. I don't think that would be, I think that would be actually quite healthy for the market. I don't think it'd be, uncommon. But I hope we just don't do that all in, a week, because if we do, I'd be more concerned about the longer term outlook of equities. I hope that made sense. But with all that being said, I want to bring in Steve and Stelios. I'd love to get their opinions. And I know Stelios is about ready to go on and on and on about Danny Blanchflower, which is awesome, because, I remember him back when he was with the, MPC and at the Bank of England as well. And I've been following him on Twitter since he left the Bank of England, I think. I have to go back. I've been following him for a long, like years and years and years. So excited to hear him speak.
Yeah, same here. I think I think we're honored to have him here. When I was a sterling rates market maker back in the mid 2000s, he was one of the voices I used to really listen to, because it's good for a committee to have voices on both sides. And I remember distinctly it was him who was always the dove, and Andrew Sentence, who was always the hawk. So you want to hear both sides of the story. As it turns out, obviously, Danny was right, because he was voting for cuts from early 2007.
Yeah, and that would be near the time where the cable went from, what was it, trading around 210 to 11.
Yeah, I don't remember their levels exactly, but yeah, it was before the big
that
crash.
Was probably one of the most epic sell-offs, and I remember shorting the crap out of the pound too at that point.
Yeah, but it's going to be great to hear him, and it was good times back then. It was Mervyn King who was the chairman. It was really interesting, and data mattered back then, surprisingly.
Yeah, data did matter, and you know what? We're going to make data cool again. Data is going to matter again sometime soon.
Eventually,
it's going to be interesting to hear his take on the sterling, especially post Brexit, and now that we've seen a really nice recovery in the cable, and I really do have a more hawkish outlook on the cable overall. That doesn't necessarily mean I want to be long with sterling right at current prices, but I am very constructive on the sterling, so it's going to be interesting to hear his take.
Feel free to interject, guys. If you're around, feel free, just like Steve. Feel free.
Yeah.
You probably don't want that.
Huh? We have multiple multiple hosts for this interview. So yeah.
So
Okay.
Steve, what's your opinion here about some of the price action that we saw yesterday? Yesterday we saw, the S&P come off these highs a little bit, and really I think it's probably, let me just go over the monthly chart since we're here. It's the 161% extension of the, pre-COVID lockdown, then the lockdown move. We hit a, big fib level. We're now showing some, rejection at this 4150 level, which is, it's been referenced quite a bit. It's pretty important. So what are your thoughts here as we head into the trading day today?
I think it's a promising rejection for a likely beginning of a pullback. Of course, somebody has to be really, really careful. As we said yesterday in the webinar as well, the trend is higher, but from a risk reward perspective, taking the other side offered an appealing proposition, right? Now, let's hope we're going to see some follow through. I think we're in need of, some follow through. And looking at the short-term charts, for example, if I look at the 4-hour chart in the S&P, looks like to me like we're bear flagging. So I would expect, to be more downside.
Yeah,
at least
so
in the
this
short
would
term.
be the bear flag that Steve's talking about right here.
Yeah.
And that's setting up. And, we do have don't forget, we have the Bank of Canada today and their rate decision. And one of the things I wanted to point out with the Bank of Canada, and this would go in line with what Steve's talking about, especially if the S&P starts to show some weakness, is that you could get the US dollar Canadian finally coming out of this ascending wedge several weeks ago. We have an inverted head and shoulder pattern. A break above 126.50 would be, bullish, and it would be positive outlook here, especially with, the S&P looking a little vulnerable. And also, I want to point out that it was just happening as we started here. Crude oil broke yesterday's lows, and if you look at crude's actually also starting to show some signs of weakness as well. So
yeah,
what else?
that was a scenario with crude as well. That was one of the scenario we were discussing with crude. That crude is either in a big triangle that will break higher, or the recent move higher was in essence a channel following the first leg lower, in which case we should have one more leg lower. And this rejection from the channel's resistance is also promising in the 61.8. So we might be about to see another leg lower in crude as well. If risk rolls over, I'm pretty sure that crude will follow.
Yeah, I would assume that crude probably follows as well. I would agree with that. And hey, I just want to remind everybody before we pass it over to Dale, if you're a Forex Analytics subscriber, we are going to be conducting the FACE webinar where we do the bias chart in about 45 minutes. So make sure you join us there. For those of you that aren't, if you're just listening along via YouTube and you're enjoying what you're hearing here, make sure you give us a thumbs up. If you're tuned in through YouTube and not through, GoToWebinar, I just said GoToWebinar. I meant Zoom. We used to use GoToWebinar.
Yeah.
For years.
Back to the future.
Yeah, right. Oh my gosh, I can't believe that just came out of my mouth. Anyway, but I also want to say, if you get an opportunity, these webinars, the FACE webinar is free. Dale searches high and low for the Danny Blanchflowers of the world, but it's obviously there's only one of him, and he's a good one today. But he's also bringing this to you, this interview to you, because Pepperstone Securities and Forest Park FX, they sponsor these videos and this webinar. So make sure you visit our video sponsors. They're the ones that help make this free webinar happen. So please visit them on forexanalytics.com. We'd appreciate that. And I just want to, and also you can learn how to get Forex Analytics for free too by opening a Pepperstone account. So with that being said, Steve and Stelios, I want to thank you guys for your input today. Coach, I want to say, have a great interview. It should be awesome. I'll be here listening in. And
I'll need
Stelios will be asking for a autograph picture.
Yeah.
Oh yeah.
Yeah, an 8x10 glossy, signed by Danny. Danny, I believe, did you call in instead of log in? Steve, maybe you could help me. I think he may have called in.
I see him in the list of attendees.
Okay, I don't show him.
I see him. I'm going to promote him.
Thank you.
There he is. Asking him to unmute as well.
Welcome to Face, Danny.
Oh, yeah.
How are you?
I'm good. Can you hear me?
Dale, I will do you the favor of actually asking a question which is irrelevant. Hello.
Hi.
Did you happen to be colleagues with Ilias Karakitsos in the BOE?
No.
Okay.
No. But I was listening to your conversations and remembering the years of being in a minority of one. And eventually Gordon Brown said to me, Danny, there's only two opinions, yours and everybody else's, and everybody else is wrong. That was one of the great lines. He called me up and said, now we're going to have to sort this thing out. So I voted alone from October 2007. But when the Prime Minister calls you up and says that, you think, okay, I'm probably doing all right.
Yeah. Yeah, well, you know, you're definitely your rep precedes you being here, Danny, and you and I have talked together. I can't remember when. It must have been many years ago when I was on FX Street.
Yeah. I mean, you know, we've been around, Guy.
Yeah, you and I, they can't get rid of us on FinTwit.
I know. And I like the thing you said about it's going to be the world of data. I mean, I'm a labor economist. And the data are a complete mess.
Yeah, markets aren't reacting to it
either. Well, here's I think the biggest puzzle. So in everything I've ever written and looked at in my life, when an economy slows, what happens is that unemployment rises and wage growth falls. So what we've got now is unemployment has risen and wage growth around the world has risen. So that's pretty tough.
Okay, so you picked a pretty interesting topic considering how euphoric the financial markets are, Danny. You know, I mean, everyone compares this era to what happened in 2000 with the dot-com bubble, anything that had .com. This, I think, is so much different because it was pretty isolated to equities and .com, but this time, you can't find an asset class that hasn't appreciated. They've even had to invent new ones.
But I listen to all the commentators, and I'm an old central banker, and I say to everybody, well, there's a really simple reason for this. It's called asset purchases. $80 billion a month of asset purchases. Central banks around the world are buying assets. Why did we do it? I mean, I remember in March 2009 when we announced that we were started to buy assets. And the reason was to raise asset prices and to encourage risk in the market. So I think all this sort of prognosticating and hand-wringing about why these asset prices are rising, I think almost exactly it's that. That was the point of it. I mean, that's why I voted for it. So I think it's not really a puzzle, and it's not really that connected to real things unless you think the reason the central banks are doing it is because of the problem of real things. And listen to Janet Yellen, listen to C.C. Rouse, and the argument is that you have to boost the real economy. What weaponry do you have? Well, you have the central banks, but now in the US you have fiscal policy moving along with monetary policy.
So do we have overkill, Danny? Larry Summers, I'm sure you know who he is. All right, I got your reaction.
I first met him in 1983 when he was the youngest full professor at Harvard, and he was a jerk then too.
You don't pull any punches anyway.
No, but the story I think perhaps we should think about is, and I think in a sense the story that I've always had in my head is that the scale of the negative shock was so enormous and huge that mostly people who argued, oh, inflation is going to take off and so on, really didn't understand the scale of the negative shock. So if you sit in Zimbabwe, and you put all this asset, you buy all this money, and the central bank prints it all, that's totally different. And I don't think the prospect of inflation rising, I mean, you may have some temporary things, and we'll see that, but the central bank needs to look through it. The central bank needs to look through and say, let's boost the economy and try to get the real economy moving again. And I'm a labor economist, and what you want to see is essentially a boost to people's nominal and real wages. And the Fed made an error in 2015, thinking we were at full employment, nowhere near it. So I think Larry and Olivier's arguments are tosh. I don't think we're likely to see that. And in any case, if you're a central banker, you and I could be the Fed. I mean, Jay Powell can call 3 people into his office, members of the committee, and say, right, let's just raise rates. It's not really hard. If you see inflation moving up hard, they know exactly what to do. We'll just vote for rate rises in the way that we voted for rate cuts. I voted for a 150 basis point cut, 100 basis point cut. Well, okay, we know what to do. So I just think the reality is that people have underestimated the scale of the shock, don't understand what central banks are doing, and realize that on the upside, it's kind of trivial. The downside is where all the risks are.
Okay, so do you think that through the Fed action after the COVID crash, they bought us a couple years or
Yeah,
longer?
I do think so. I think that's right. But the thing I always have in my head, I mean, think about the UK. You have rates sitting at 10 bips. I mean, rates are sitting at 10 bips. And obviously there's a debate going on about whether you could go negative and where you could go. I mean, the reality is that you have to move to fiscal things, as Janet has argued, because how far can you go? I mean, how negative can you go? I mean, I should go back. The reason we did QE in 2009 was essentially the staff were sort of estimating what should interest rates be. Think of the adjustment. Here's the economy. You adjust rates, you change rates by 25 bits. What do you do? And we had meetings where they were talking about the models were showing rates should be -4, -5. And that the reality was, how the hell can you go there? And the reason you do QE is you say, well, we can't go to -5. So if you can't reduce the price of money, you have to raise the quantity. And I think we're still there. I mean, we saw Japan yesterday at the meeting saying, likelihood is they don't think inflation is going to get to 2 for a really long time. And we're going to keep the stimulus going. And I think that's the reality. But for Larry Summers and Olivier, who in August 2008 said the state of macro is good and hadn't spotted that the US had been in recession for 8 months already, I think they're not credible sources.
Okay, so we have this K recovery, right? That's the letter everyone's
Well,
using.
right.
So is that the despair, Danny? I mean,
Yeah.
I read a little bit about your piece, and it's an interesting topic with euphoria in the markets.
Yeah.
But is the upper K that is euphoric and happy, while the bottom K, like my partner Blake Morrow said, is priced out of being able to buy a house?
Well, exactly.
ahead.
No, exactly. Well, so let's go to what. So I remember Janet Yellen when at the Fed having a meeting about inequality and worrying about, we're doing quantitative easing, and obviously asset holders were hurt, but what you end up doing is you end up buying assets and helping asset holders. And I was in the UK, one interest rate help is it's too low in London and it's too high in Scotland, right? So then the reality is, okay, so the market's doing fine. People own stocks and shares and houses are doing fine. What about the rest? And I think you have to then sort of connect to, well, why was there a burst of populism? Why was there a burst of populism in the UK and in the US? The reality is it's the people without a college education. Well, what's going on with them? And there's a whole series of evidence now, driven particularly by this work by Case and Deaton on deaths of despair. But we've been working a lot on trying to look at, well, who were these Trump voters? What were these people thinking? And I've written a lot about the lack of good jobs was a really big deal. you know, for the less educated, the quality job that was there in 1975 isn't there today. And we've documented this huge rise in what I call despair. I have a picture if you'd like me to show you.
Okay, you can.
Can I share
you
the
can.
screen and show you?
Yeah, share. Go ahead. Go ahead
So-
and share
so
and
this-
hit the green button.
Yeah, this is
Okay.
a scary picture. So this is so this is data asking folks over the last 30 days, how many of those days were bad mental health days? So this is a pretty good indicator. And if I ask your listeners, most people just say 0. So 2/3 of the people say 0. So the question is, who says 30? Who says 30 of the last 30 days, all of the last days were despairing, terrible days? And the answer is, if you look here, we're talking, so this is for less educated, prime age. We're talking about 1 in 10 of whites, about 1 in 8 of blacks. And if you look at natives, we're talking, you know, we're talking numbers in 15% or so. So this astonishing rise is a really big deal. And precisely, so think of this as morbidity. The mortality data is exactly like this: suicides, opioid deaths. If we look at Native Americans, we just had some data out which says an enormous rise in the deaths of Native Americans from
COVID.
meth overdoses. Yeah, and of course, the same people have been hit by COVID. And so this seems like there's your K-shaped recovery. The non-college, I mean, that's unbelievable. This is 1 in 10 white prime age people who are non-college, and higher than that still. So there's your K-shaped recovery. And if you look over time, the rise over time is dramatic. So there's the K. And what are we doing about it? I mean, in some sense, the Biden, I'll unshare my screen now, but okay. I think that's an astonishing picture. And so the K-shaped recovery, and Janet Yellen and CC Rouse are labor economist friends. I've known them for 30 years, but they are on this one. And in a sense, the more the recovery of the top part of the K goes, what we've learned is that relative things matter, right? So the story in behavioral economics that I've worked on is that, you know, if I see you all doing really, really well, that impacts me. So I think, you know, I think the reality is that this is all very well, the stock market rise and the exchange rate doing things and so on, and low interest rates, and we're worrying about, you know, stock X and stock Y. We have to worry about the fact that, you know, 90,000 people die from opioid poisoning. Suicide rates are up. Alcohol rates are up. What are we doing about it? And in a sense, those numbers
we're sending checks.
Well, we're sending checks, but that's not solving the problem, right? I mean, if I just say 1 in 10 people who are less educated say that every day of their life is a bad mental health day. Well, and that's
maybe
right.
they're currency traders.
Yeah. I mean, remember the thing in the Wall Street crash? People did throw themselves out of windows, right?
Yeah.
I mean, that's not. I mean, in a way, what people know now, in a sense, the reality for the traders is that when a decline comes, the obvious worry is that everybody sells like crazy, and the decline is greater. Well, why? Because they know that the central bank the only show in town for the central bank is to do more QE again and rescue them. So the danger is that we then have much greater volatility in the markets, because everyone knows that the Fed is going to step in, which they didn't know in 2000.
Okay, well, let me ask you about this. We'll go to some markets. That was an interesting graph, but the recent rise in yields that we had, the 10-year go from about 0.5 to 1.5, 1 3/4, Danny. That wasn't the Fed.
No.
Remember the guys they used to call bond vigilantes? Are they back?
Well,
they're old now. They're a bunch of old men, old vigilantes.
Like us. No, I mean, I think in a sense. So I gave a talk yesterday, and I wrote a piece in the Scottish Herald, because there's something interesting in the UK. Is there's an election going on in Scotland, and then why does that matter? Well, because in all probability, that's going to generate a vote, probably, for Scottish independence. And the question is, well, where would the world go if you were to be independent? What would it look like? If you're not being independent, what would it look like? And the answer is that I just think this is a response to what did people call it? Knightian uncertainty. That means uncertainty that we have no history of in the past. We can't ascribe probabilities to. And the answer is that, well, looking forward, what I think the biggest deal, and bond traders, I think, have worked it out, is that, yeah, okay, we worry about what firms are going to do, what governments are going to do, how the vaccine is going to work, how the virus is going to spread. But more than anything, I think the great uncertainty is what long-run changes in behavior are there going to be? You know, there'll be short-run changes and we'll have a short-run recovery. But then do people stop commuting in? Do people stop going? What in the long run do they do? What proportion of the firms that have been furloughed around the world don't survive? And that, I think, means that nobody can really run a forecast like they used to. I mean, much as they were terrible, I think what you have to do is you are now in the world of scenarios, which is if people do this, it looks like this. If people do that, it looks like that. And in the end, I say the best thing that any central banker can do, any forecaster can do, is to say, it depends. I don't know. I have nothing in the past. I mean, I do a lot of this with my students.
Well, you have a pandemic from 100 years ago.
Well, so
that's it.
Well, I think you're right. I think you go back to 1929. I mean, the reality is that the crash in 1929 started in the Florida housing market. The crash of 2006, 7, 8 started in the Florida housing market. And we have evidence from the 2018 great influenza as to what happened. But historically, I mean, I think when I listen to various people talking about what the Fed's going to do, and I always say, well, you have nothing in the last since 1945 that tells you anything in these scenarios. So I think the answer is that bond markets appropriately are responding to vast amounts of uncertainty. Because, you know, think about, you try and run some econometrics, you ain't got nothing to put in the equation. We have nothing in the past that looks like this. Banks, we don't have evidence where other banks were in negative territory. They were doing QE. We had a shock, which was, you know, a dramatic drop in output in the space of, you know, 1 month. And just go back to one other thing. So in relation to well-being, we have seen collapse in happiness around the world, or measured by whatever you like, which we'd never seen before. So I show my students the 2008 crash, apart from in Greece, wasn't happiness reducing. Yeah. If you look around the world now, you see a complete collapse. I'm going to give you an example in the UK. The Office of National Statistics has asked people about happiness for about 6 or 7 years now. And the average score from 2015 to 2020 was about 7.7. You know, the average 0 to 10, average of about 7.7. In March 2020, it dropped from 7.7 to 5.2. It's picked up a bit to 6, but we have never, ever seen anything like this. So what does it mean? Don't know. What are the implications when people are scared senseless? Don't know.
People still could have PTSD. There's variants out there, the news that we get, Danny,
right.
You know, all the uncertainty.
I think that's completely right. And so the logic is, so you think everything's going to be back to 7.7 next year? Well, I don't know. I mean, I just don't know. I have no way of telling. So I think markets are appropriately, you know, well, A, they're concerned, and B, it's hard to think that very quickly things are going to be better. The probability is things will be worse. You know, maybe people won't, they'll carry on saving, they won't spend as much. That'll be bad for markets, bad for output. What will the government do? Will governments bail out on these furlough schemes? So I think the answer is that, you know, the right answer, that when you ask people on your program what's coming, the right answer you must always say to them, well, it depends, right? And the ultimate thing it depends upon is what are people going to do who are scared senseless in a way they've never been scared senseless before? Will they remember that? And I think you said it well. Chances are they will. And that, I think, is a really crucial thing for markets to hear.
Okay. When we look at these markets here, Danny, what is your impression about all the new types of instruments and ways to invest, SPACs, NFTs? You know, people are just buying. Speculation, I think, is running rampant. I've never seen GameStop, the Reddit people, this type of, you know, euphoria in the markets. You know, you talk about people being unhappy now, Danny. What do you think would happen? Like we had that guy blow out 5 billion in a couple of days in his hedge
Right.
fund, and that's during an up market. What would happen if a bear market ever appeared here in global bourses and people aren't happy now with at least cosmetically things looking okay? What's going to happen if we go through a period of asset deflation?
Well, I don't think the word's if, it's the word's going to be when.
Okay.
Right? I mean,
All right,
obviously,
yeah.
things have
The
been-
art of it is when.
Yeah, yeah. Well, the art of it is obviously the timing, but the problem is a lot of young folks have not really, I mean, they have not experienced the downturn. I mean, obviously, go back to what I said. I think people are aware, and in a sense, the Fed has to deal with this prospect, which is the Fed's the backstop. The Fed's going to rescue them, and I think that's obviously something we need to think about. But clearly, in a day trading's fine in an up market, which is sort of what you said to me, right? Yeah, anyone, you have a monkey throwing darts at a dartboard, and they can do fine on an uptick. I mean, I think the answer is that. If we look back, and I've done this a lot with my students, the hardest thing of all is to pick a downturn. So think everything's rising steadily. So agencies like the Census and Commerce and in the UK, the Office of National Statistics, they basically just forecast things as a steady trend up. It's very hard to pick a downturn, and actually you often just get that in the revisions. So I think that's the big worry. And I think, in a sense, somebody like me, I mean, I remember, let me tell you a story about the seriousness of a downtick. And I actually interviewed Alistair Darling. There's a great story. He was the British Chancellor of the Exchequer. And he tells this story, which was that he was sitting in Paris in a meeting on the 7th of October, 2008, sitting in a meeting of the European finance ministers next to Christine Lagarde. And his assistant came to him and said, "You've got to take a phone call." And the phone call was from Tom McKillop, who was the chairman of RBS. And he said to Darling, "I can't make a payment." And Darling said, "Well, how much?" And he said, "About $75 billion. And he said, "Oh my goodness." And he eventually goes back to London and he says to his staff, what if I don't rescue? And people didn't know this. So this is what happened in secret. You didn't know this for years. And he said to his assistant, "So what if I don't rescue RBS?" And his assistant said to him, "Well, there's a prospect that every credit card in the world and every cash machine in the world tomorrow stops working." And Tim Geithner, Dartmouth grad, came to Dartmouth and said, on that day, the world sat on the edge of a precipice. And I think, and it was Armageddon. And so then the next day, they rescue RBS, and 7 central banks in the world cut rates together. But the reality is that people are not aware. People are not aware of how close the economies can come. Just think about that day. So that's the day. Okay, Lehman Brothers failed, but the lack of failure of RBS was crucial because it's the largest bank by assets in the world. So people should not underestimate the possibility that banking crises come. And if banks start to fail, the global economy collapses. And I think people underestimate the fact that such things can come very quickly, they can come rapidly, and the economy can be at the edge of Armageddon. I mean, go back, every cash machine in the world and every credit card, basically the prospect was if they didn't rescue RBS secretly, and you didn't know it, market traders didn't know it. So imagine what might have happened. And the reason, in a sense, that the euphoria has to be thought through is that came, I mean, it was not entire, well, probably if you look back, people were not aware of it. So I think being not aware and also understanding that when downturns come, central banks and policymakers know things that markets don't know. People therefore have to be wary that what goes up will come down, and it usually will come down by financial failures.
I've interviewed quite a few people that have that concern about the Italian banking system that, and maybe, why do you think Draghi is taking the lead in Italy, Danny?
I mean, in a sense, so I would go further, and I think you were very spot on to say that. So think about, so when the housing crash comes in the US subprime. Turns out that the Landesbank in Germany fails. Well, the reason it was set up to go and build public sector stuff in East Germany. And then we get to the early 2000s, it's like, got money, so let's go and invest in housing in Detroit. So the collapse of the housing market in Detroit brings down a German bank. An Italian bank fails, and every other bank around the world is linked to it and goes with it. And I think that that's the big part of it, which is that all these banks are linked together. I mean, the insight that I had, in a sense, that other people on the Bank of England didn't have, was that, sounds crazy, I had meetings of my students when I was sitting in the bank. I had meetings of my students who worked in Canary Wharf. And what I discovered very quickly was that actually the banks that they were working for in Canary Wharf were exactly the same banks that were sitting in Wall Street. They'd just come over for 3 months. And I very quickly realized, and one of the big reasons I started to vote for rate cuts was that it looked to me that, how can a banking crisis in America not spread to the United Kingdom and elsewhere? I mean, Mervyn King had spent a long time saying that the two economies were decoupled, and I kept making speeches. That was the most ridiculous thing I'd ever heard. So given that, given the Italian banks are also trading with American banks and British banks, and they're all linked together, the reality for the US economy is you have to care about Italian banks, right? You care about Japanese. I mean, here's another one. I was sitting on Bloomberg on the night of the Brexit vote.
Okay.
And just as we actually had to explain to people what a Sunderland was. And a Sunderland, which was a place in England, and the vote suddenly said that they were going to go to Brexit. And we watched in China and Japan and Australia and New Zealand as bank shares started to move on the basis of a decision made in Sunderland. So I take the view, I mean, your view exactly, you put Draghi in there because America cares about Italian banks and has to. And I think that's the thing. I think people forget that everything is linked together. And what happened on October the 8th was that the 6 of the world's central banks operated together because we knew the global banking system existed. So you had, the ECB, the Bank of England, the Fed, the Bank of Japan, the Swedish central bank, and the Swiss central bank. And then the next day, the Chinese central bank moved too. So I just think we're in this world where, one down, all down. And I think people have underestimated that.
Okay, we here in the U.S. were having trouble in the repo market, and that wasn't Italian banks, right? People being not able to trust to lend and transfer money to other U.S. banks. And so, there are a lot of structural issues that are still out there. Danny, let me wrap it with, what was your view on Brexit, and is the pound going to become a safe haven currency because they're not going to be locked into the euro here? Maybe they benefit from this.
Well, I mean, obviously, I thought that Brexit, the deal that was done, looked to be a disaster, and that's appeared to be unscrambling. I mean, almost inevitably, what it's generated. I mean, I'm now attached to the University of Glasgow. And the debate is going to, I mean, we should talk after May 6th. We're going to see this vote on May the 6th. Right. I suspect it's going to be a big move to support voters for independence. And essentially what Brexit has done is it's pushed out Scotland. And if Scotland goes, it'll probably pull up Northern Ireland with it. Northern Ireland, now there's almost exactly a united Ireland. And obviously the problem right now is to separate out the pandemic from Brexit, which is still sort of disentangling. It looks that particularly Europe is in some trouble. But I think once again, it's hard to separate the things out, but it certainly looks, when you look at things like the fishing industry and shellfish and all these issues about how you're going to deal with Ireland and the bureaucracy. So it certainly looks that it's a major issue. And I think it's going to generate a vote for Scotland to be independent. And conversations like Alex Salmond, ex-First Minister, yesterday came out and starts to talk about not only should Scotland become independent, but it should have an independent currency, separate currency. They might call it the Scotty or the Kilty or something. But we're in a world where Brexit has basically pushed countries apart.
Well, you could come up with a crypto like Dogcoin and use that. So, Danny, take a minute or two and give me a thumbs up or thumbs down on crypto. And will central banks, are they allowing this experiment in cryptos to happen so that the public becomes comfortable with the concept so that they could have their own?
Well, it certainly looks that way. I mean, it certainly looks that they're going to explore it. I mean, in a sense, I think one of the big arguments, I think, is this, which people may not have thought of. I mean, if you have that, you have cryptocurrencies. I mean, in a way, you generate yourself a new weapon. Think about what the Treasury has done to do its stimulus. People who filed with the Treasury got a account on hand. You can put money into it. In some sense, that will allow the central bank to have another weapon, which is they can, there's this cryptocurrency and everybody's got a record. The central bank can put money in people's accounts. The worry is it could take money out of people's accounts.
Right.
But, I mean, I do think that. I think, we're seeing people now, we're seeing central banks starting to think about what this means. I mean, it obviously relates to the discussion about, should you have real currency? I mean, I'm a professor at Dartmouth, and as far as I can tell, not a single student ever has a dollar bill in their pocket.
Yeah,
ever.
More on cash.
There's nobody. I sometimes say in my class, I say, because I quite like to take a dollar bill out and look on it, because now we can look at which of the banks. And you open it, it's got Dallas Fed. And I say, how many people in the class has got a dollar bill? And there's not a single person, not a single person. They can pay for everything with bits of plastic. So I think the answer is that, we know where this is going. It's just old guys like me. I'm the only one who pulls out a dollar bill. So I think the answer is that in a sense, it's the inevitability, right? I mean, they go and buy a cup of coffee, $2 cup of coffee they pay with plastic. Whatever. So I think
there's COVID. You can get sick handling cash. They're using COVID for an excuse for everything.
Exactly.
Danny, really was great getting back together with you. I don't want to let this kind of time pass again. And I know you're a big fisherman.
I'm a snook guy.
Yeah, I saw that. So, a priest once told me when talking about changing people's minds and converting them, that first you catch the fish, then you clean it. Is that true?
Well,
because some people try and convert the fish before they catch them.
What I do is I release the fish.
Oh, okay.
I always do catch and release, because I live in Sanibel Island in Florida. I live in a fishery, and I take the view this is a good one to think of. So I always release it, hoping next year I can recatch it and bigger. So think of the market. You don't want to go nuke it, because actually this thing might have a really strong rate of return next year. Here's another story I like. Well, snook, I always tell this to my students. So snook are all born male, but as they get bigger, they become female. So female snook are smarter than male snook by definition, because the dumb ones are dead, right? So
the smart ones became women, female.
Exactly. Stock pickers, right? But I think this conversation has been a good one, in the sense that I think somehow people have not understood quite what central bankers like me saw. So the thing I would sort of say is that we saw this horrible shock, much greater shock than anybody saw. And we went to the edge of Armageddon. And I think that explains why Larry Summers and Olivia Blanchard are wrong. They didn't really see it. They weren't sitting in the room. But those of us who were, Janet Yellen, Bernanke, and me and others, we just saw how close the world came to Armageddon. And I think the reality is that to understand what the central banks and Janet Yellen and stuff are going to do, they're going to overcook it if necessary, because they're too afraid of undercooking it.
Yeah, and wasn't that fantastic how they, after Paul tightened in his first year as Fed chairman, that both Bernanke and Yellen, they had a meeting, they held hands and sang Kumbaya. And he changed his mind.
Well, I go back. The great thing about Janet Yellen and CC Rouse, they're labor economists and they're data people. Start where you started. I was first called by Janet Yellen. She called me up when, I think it was in 1993 or 4. She was governor at the Fed. She called me up and she said, Danny, this is a bit technical. She said, Danny, your wage equations are better than ours. Can you come down and talk to me about them? And so I went down to the Fed and talked to Janet Yellen about the data, right? Yeah, so Janet's a data person. There's a great story of her husband, Nobel Prize winner, and his prize-winning speech, he said, I'm really pleased to win this prize. I should just tell you, I'm the second best economist in my household.
Yeah.
So, you know, so
Nice.
you've got data people, you've got people who actually understand how to analyze the data and understand what they don't know. And I think that's where we are. A lot of this stuff we just don't know. It depends, remember, it depends.
The older I get, the more I know I don't know, Danny. So
I agree with that. Think about what undergraduate education's about.
Yeah.
After 4 years at Dartmouth, you realize that you knew less than you did when you came, right?
thank you so much for your time. I would love to
Sure.
audit one of your courses, Danny.
Yes.
And really appreciate you coming here, and would like
course.
to have you come back and let's see how things are unfolding here in the world economy.
Well, invite me, and I think we're going to see this interesting debate in Scotland. I mean, I've got
Okay.
students, so I've got students actually working on the Czech Republic and Slovakia. If you think about if Scotland's going to separate, what's the history? So Czechoslovakia is an example
Right.
where two countries split apart. Let's think about what would happen. And markets, it's going to be a really big deal. Should they get a central bank? Should they get their own currency? What would it look like? How will it affect, how will it affect the pound? Because if this vote on May 6th happens, this is going to impact the pound, I would thought.
Okay. Let's wrap it with some pound volatility coming up in May.
Yes,
Danny Blanchflower, and you could follow Danny on Twitter. Important guy to follow. You could follow him at D, and it's _ Blanchflower. Danny _ Blanchflower. And thank you, Danny. Look forward to doing this again with you, my
Thank
friend.
you.
All right.
Bye.
That's a wrap, everyone. Remember, don't just count your pips, count your blessings. We'll see everyone tomorrow, and good hunting the rest of the day. Everyone's thanking you, Danny. You're a hit.
Good.
All right.
I'll get the chat.
All right. See you, buddy.
Thank you.
All right. That's a wrap, and you could join the team for Morning Edge in 9 minutes. Adios, everyone.
Yes, all.
Thanks again, Danny.
Sir.